Now here's another one. This will apply to virtually anybody that has stocks outside a retirement account. And take a look at this. This is just, hypothetical stock starting in 2002. It went way up, and then what happened? The Great Recession, it went down, and now it's back up again. So you have an opportunity. It's called tax loss harvesting. And here it is. When the market is down, you actually want to sell that stock, because when you sell that stock, you create a loss on your tax return. It's really important, though, when you sell the stock, it's not like you want to lose money, but the reality is stocks sometimes go down. You buy another stock or mutual fund that's very much the same, so you're still in the market. And when the market recovers, you receive the recovery. In the meantime, you've got this loss that shows up on your tax return, and that loss nets against dollar for dollar against future capital gains, whether it's the current year or if you don't have enough gains, it carries over for the rest of your life. People don't realize this. When you have a capital loss, let's say you have a $50,000 capital loss and you have a $50,000 capital gain on another asset like a stock sale, real estate, you can net those two together and pay no tax whatsoever.
One of the most confusing things here, Al, is that most people, when they look at a capital loss, they'll say, well, I can only write off $3,000. But that's not the case. I mean, if you have a $10,000, $20,000, $50,000 capital loss, let's say, depending on the size of your portfolio, that's fairly easy to do, is that now that capital loss will offset any capital gains, and that will carry over for the rest of your life until you use them all up. The $3,000 carryover is against ordinary income, and Al, I think a lot of people get confused a little bit on that.
Well, they do, Joe, and so to reiterate, so capital gain or capital losses net against capital gains dollar for dollar. Quick example. So I've got a stock, I bought it for $100,000, now it's worth $50,000. I sell it, I got a $50,000 loss. That shows up on my tax return. If I have no more capital gains, I'm allowed to take $3,000 of that $50,000 loss, use that against ordinary income for salaries, interest, dividends, and then I carry forward $47,000 next year. Next year I do the same thing. I look at it, what are my capital gains? Well, next year I sell a stock, I bought it for $5,000, I sell it for $15,000. Okay, I got a $10,000 gain. That gain nets against that $47,000 carry forward, dollar for dollar. Now I've got a $37,000 loss, and I still get another $3,000 to use against ordinary income. The rest, $34,000, then carries forward to next year. You never lose these carry forwards as long as you're living, so there's no reason not to do this tax loss harvesting when it's available.